Also some new concerns about Italy and Greece. S&P said it may downgrade Italy's debt, and Fitch cut Greece's credit rating. For more on all of this, I want to bring in Axel Merk. He's the president and chief investment officer at Merk Investments, with about a third of his largest fund in euro assets. Axel, thank you very much for joining us. We know what some of the catalysts are for this selling, but what do you think is really going on here?
Good morning. Well, what we have been arguing for a while, that we have this wonderful dialogue happening between the bond market and policymakers. The bond market is the only language policymakers will listen to. Once the bond market imposes austerity on a country, that's when they follow through. And when there's a backing off, when things are going better, then the targets are being lapsed. And so it is urgently necessary to have this sort of dialogue. And ultimately, the bond market is going to prevail. Now, it's a very ugly process, obviously, and it's going to play out differently in different countries.
Right.
And what we've argued is that the issues in the Eurozone should be priced into the spreads in the bond markets, but the euro could do quite well in this environment.
But you have a lot of euro assets. You have a lot of assets also just in European, well, you have a lot of money in European assets. Why do you call this a wonderful dialogue? It's creating a mess.
Well, obviously it's creating a mess, but the reason we are in this mess is because the bond market was too benign in the last decade. And now the bond market is encouraging countries like Germany, France, but also Spain, Ireland, and other countries to introduce austerity measures. Europe knows it can't outgrow itself. Now, one of the things we have said is that it's really up to each one of these countries to determine their own destiny. The European economy as a whole is doing quite okay in this environment, but these peripheral countries are doing very poorly. Now, these peripheral countries can do better, but only if they implement reform. And as we've seen with the election in Spain, for example, there are significant setbacks that come along the way. And with that, it will just take Spain longer to reach its targets. Nobody is really expecting that these targets are implemented perfectly. In the case of Greece, it's obviously a far way off. But in other countries, in the northern European countries, it's much better.
But Axel, I'm trying to figure out what you're saying, because you know, that bridge has been crossed. There is no way that any of these countries that are troubled right now can do anything independently anymore, don't you think?
Well, yes, what I'm saying here in the context of the euro and the markets is that it's more difficult to spend and print money in the Eurozone than in the US. In the US, we haven't even started to tackle the same issues that we have, because the bond market is behaving. And what we see is that a country like Germany is doing very, very well in this environment. You said we hold a lot of euro, by all means, but we don't hold any Southern European debt. What we hold is Northern European debt, the German, Finnish, Dutch debt. And those countries are benefiting. And we believe that the euro as a whole is going to thrive, yet these peripheral countries are going to suffer. By all means, these problems are very real and very, very serious.
So when you say suffer, are we talking about a default possibly in the cards?
Well, it really depends on the country. One of the things we have said is that it's not really in anybody's interest to happen too soon. Any country can default on its debt. But if that were to happen, you have a tremendous shock to your primary deficit, because you can't raise any money the next day. And as such, Greece in particular, they should be implementing more reform so that they get their primary deficit under order. The political dynamics will not likely last as long as necessary, which means Greece is going to have very serious problems down the road. But they're not helping themselves by defaulting because they're not fixing the underlying issues. Other countries are far more responsible. In Ireland, political dynamics may lead to a default at some point, but Spain is at the other end of the spectrum. Spain has a real economy. Spain has had a housing bust, but they don't have many of these underlying issues, and they've been tackling the issues in the banking sector. By all means, it's gotten more difficult with this election, but Spain will get through this.
But okay, but let's just say that there was a default. Okay, I mean, I know that's not, you know, a default by itself is not going to force these countries to restructure, but what if there was a default? Would that, you know, is that what is necessary to get these countries back on track?
No, what a default will do is it will accelerate the process in which the rest of the banking system, the Eurozone, needs to raise capital. That's the main implication for the markets as a whole. We know that the European Central Bank has been a very bad poker player. And so while they're encouraging everybody, when push comes to shove, the European Central Bank will support the banking system as much as needed. But banks in Germany, France, and other countries need to realize that they just have to raise more capital. And a lot of that has been happening, but they have to accelerate that. Now, the reform process in these countries with the restructuring will continue depending on the country. Greece is in a very dangerous crossroads, and Greece may fall into chaos if they default too early. And while that's very bad for the Eurozone as a whole, for Europe as a whole, while it's not good, it's not the end of the Eurozone.
All right, Axel, thank you very much for your comments on that. Axel Merk of Merk Investments, as you'd mentioned, has a lot of money into euro assets.